Good evening everyone and welcome to today's market analysis. Let me start with the key numbers from last Friday. The Nasdaq closed at 26,683.94, up 3.07%. The S&P 500 finished at 7,554.29, gaining 1.65%. The Dow Jones ended at 51,671.03, up 0.92%. The VIX Volatility Index stood at 16.20, dropping 8.37%. The 10-year Treasury yield was at 4.47%, down 0.4%. The dollar index came in at 99.66, up 0.24%. The offshore yuan against the dollar was at 6.7576, basically flat. Bitcoin traded at $66,206.34, up 1.19%. WTI crude oil was at $81.43, up 0.74%. Spot gold closed at $4,332.10, down 0.39%. Today the strongest market direction was the Chinext index on China's A-share market, which surged 5.3%. The weakest was spot gold, down 0.39%. I should note that we are missing today's closing data for U.S. stocks, so we are using last Friday's close and after-hours futures data, which means our conclusions come with slightly lower confidence. Here is the big picture for today. This is a textbook risk-on day. Money is moving out of safe haven assets and into tech and growth stocks. Even though we do not have the final U.S. stock market close, the evidence is overwhelming. The Chinext index in China jumped 5.3%, the Shenzhen composite gained 3.79%, and the Shanghai composite rose 1.61%. European markets were broadly higher with the German DAX and French CAC both up more than 1.5%. U.S. stock futures were strong throughout the session with Nasdaq futures up 1.84%. All of this points to one clear conclusion. Global capital is flowing in one direction. Buy high beta tech stocks and crypto-related assets. Sell gold and defensive positions. The VIX falling sharply combined with positive signals on geopolitical tensions further reinforced this risk-on mood. Let me walk you through the global trading day. In Asia, the A-share market opened and moved higher in a straight line. The Chinext led the rally with strong volume. Market sentiment was very positive and there was no sign of the so-called pullback from last Friday's U.S. session. Then came Europe. Major indices opened higher and kept climbing, continuing the risk on momentum and creating a seamless handoff from Asia. In the U.S. futures session, Nasdaq futures kept rising and S&P futures followed, but Dow futures edged slightly lower. This shows a clear divergence. Tech is strong, traditional value is weak. The leaders today were clearly the Chinext index and Nasdaq futures. The laggards were Dow futures and spot gold. The key turning point came right after the Asian Open when the A-share market broke higher without any hesitation, completely ignoring the negative news about AI chip restrictions over the weekend. Our previous forecast predicted that the market would fall today because of the AI chip restriction news. That turned out to be completely wrong. The market rallied strongly across the board. Here is why we got it wrong. The market treated the restriction news as a case of the shoe finally dropping. Combined with rumors about a dovish Federal Reserve and easing geopolitical tensions, risk appetite exploded. Investors chose to interpret the news as a sell the rumor, buy the fact event. The biggest surprises were the VIX dropping sharply and the Chinext breaking out on heavy volume. This tells us that in the current market environment, risk appetite carries much more weight than short-term policy negatives. A new structural signal emerged today. Chinese tech stocks and global tech growth stocks are moving in sync. The probability of this being a sustained trend is around 70%. The market completely ignored the substantive negative impact of the chip restrictions and also shrugged off a small rebound in the dollar. Now let us look at the triple linkage between currencies, bonds, and equities. The dollar index edged up 0.24%. The yuan remained stable against the dollar, creating no pressure. Chinese stocks and U.S. stock futures rose together, showing co-movement rather than divergence. The 10-year Treasury yield fell from 4.4870% to 4.4690%. Lower interest rates support growth stock valuations. So we have a stable dollar, falling rates, and rising stocks. This is a classic risk-on combination. For tomorrow's Asian session, this means the A share market is likely to maintain its strength. But we need to watch for potential profit taking after the opening gap higher. The key thing to monitor is whether northbound capital flows continue to come in. Let me break down the strongest and weakest sectors today. The strongest direction was Chinese tech growth stocks. The Chi-Next rose 5.3% and the Shenzhen Composite gained 3.79%. The driving logic is a rebound in risk appetite combined with expectations for domestic substitution. The AI chip restrictions actually boosted confidence in the domestic supply chain. The Chi-Next posted the highest gain across all markets and broke through its previous trading range on heavy volume. The probability for this trend continuing is around 80%, but we need to confirm it tomorrow since this is the first clear directional shift. Another strong direction was crypto-related concepts. MSTR rose 5.43%, EBIT gained 4.89%, and Bitcoin was up 1.19%. The driving logic is risk on sentiment combined with Bitcoin stabilizing and bouncing. The probability here is around 70%. The weakest direction was gold. Spot gold fell 0.39% as safe haven demand declined and money flowed out. The probability of gold continuing to underperform is around 65%. Let me give you 4 verifiable predictions for tomorrow. First, the Shanghai Composite is expected to be range-bound with an upward bias. Direction up, probability 60%, expected range 40.50 to 41.50. The core driver is momentum and strong overnight U.S. futures. The risk is that if U.S. futures turn lower during the session, it could trigger profit taking in Chinese stocks. The verification standard is whether the first 30 minutes of trading volume exceeds today's level. The failure signal is if the Shanghai Composite opens below 40.30. Second, the tech sector led by the Chi-Next is expected to continue leading. Direction up, probability 55%, expected gain of 1 to 2%. The core driver is sustained risk appetite and money flowing from gold. The risk is short-term overbought conditions. The verification standard is whether the Chi-Next gains more than 1.5% in the first 30 minutes. The failure signal is if the Chi-Next turns negative during the session. Third, the dollar index is expected to edge lower. Direction down, probability 55%, expected range 99.2 to 99.5. The core driver is continued dovish rumors. The risk is a sudden hawkish comment from a Fed official. The verification standard is whether the dollar index breaks below 99.5. The failure signal is if it rises back above 99.8. Fourth, the 10-year Treasury yield is expected to trade in a narrow range with a downward bias. Direction slightly down, probability 55%, expected range 4.40 to 4.5%. The core driver is risk appetite suppressing demand for safe haven bonds. The risk is weak demand at a Treasury auction. The verification standard is whether the yield touches 4.42%. The failure signal is if the yield bounces back above 4.53%. Let me do a quick self-correction on our model. Our forecast this morning scored only 3 out of 10 because our direction was completely wrong. We had no correct calls. Our mistake was focusing too much on the AI chip restriction as a negative and underestimating how quickly and powerfully market risk appetite could shift. Here are the changes we need to make to our model. First, reduce the geopolitical risk weight from 0.25 to 0.15, and always consider the possibility of a sell the rumor, by the fact scenario when a negative event is already widely expected. Second, increase the priority of risk appetite confirmation indicators in our morning report, specifically the VIX level and the direction of U.S. stock futures at the open. Third, the correlation between Chinese stocks and U.S. stocks is stronger than we expected in a risk-on environment, so we should increase the weight of cross-market correlation coefficients. For tomorrow's morning report, our key focuses will be the direction of U.S. stock futures at the open, whether the VIX stays below 16.5, and the flow of northbound capital into Chinese stocks. We will ignore short-term dollar fluctuations unless the dollar index breaks above 100. In terms of trading strategy, our bias is to be long with controlled position sizing, focusing on Chinese tech stocks and U.S. tech ETF futures. Our confidence level is 0.70. The conditions for early positioning are Nasdaq futures holding above 30,600, the VIX staying below 16.5, and the offshore yuan not rising above 6.77. The conditions for standing aside are if U.S. stock futures open down more than 0.5% or if the VIX jumps above 18. The failure signals are if the dollar index breaks above 100 or if the 10-year yield rises back above 4.55%. Here is our final probability assessment for tomorrow. We see a 60% chance of further upside, a 25% chance of a sideways consolidation, and a 15% chance of a pullback. The direction is clear. Risk appetite is in the driver's seat and investors should follow the momentum. But stay vigilant and watch the key verification signals we have outlined. Thank you for watching and we will see you tomorrow.